Hello, this is Joe Hoyle speaking to you from the University of Richmond. And today we're going to talk about gift cards. My guess is that almost everybody who is watching this video has bought a gift card at one time or another. Interestingly, if you go back 10 or 15 years, there was literally nothing like a gift card. Oh, you could buy gift certificates, but they were fairly rare. So when I used to teach accounting 10 or 15 years ago, I would never even talk about this topic. This is one of the examples how business changes, and therefore accounting also has to change. Today, if you go into a grocery store, there'll be a kiosk there where you can buy literally dozens of gift cards for dozens of different businesses. It's hard to go into any business today that doesn't sell gift cards. So over the last 10 or 15 years, this has gone from being a topic that no one talked about to a topic that everyone in accounting is very much aware of. How do you report the money that you receive from selling a gift card? Our video problem here today, your roommate has come to you. Now remember, the roommate's parents own a series of ice cream stores in Florida, and she tells you the good news. They have started selling gift cards, and they did it right before Christmas so that all of the grandparents in Florida could buy gift cards for their grandchildren. And they sold bunches of these gift cards. Now this is something new for this company. They haven't done it in the past, but we all know how this has to be reported. But the roommate doesn't know because the roommate hasn't taken a financial accounting course. So what we're looking at is, if you go to a store and you sell, or they sell you a gift card, how do they report that? Well, the answer is a gift card is just a liability because they owe you something. They owe you some ice cream, or if it's a bookstore, they owe you a book. So they cannot report a revenue at the time they sell that gift card. They might like to, but they can't because the earning process is not yet substantially completed. They've not yet done what they're taking the money for. They have taken the money with the promise that they will provide ice cream to these people's grandchildren. When they provide the ice cream, that's the earning process, and they can recognize the revenue at that point. But until then, they owe that service to those customers. So that when they sell, when the roommate's parents' company sells a gift card, they will debit cash for, let's say, $50 and credit unearned revenue. It's unearned because even though they made the sale, they have not yet done the work that they're required to do. So more and more, if you go look at a balance sheet for a company like a bookstore or electronics store or a music store, you'll see a liability, something like gift card liability or unearned revenue liability, to indicate that they've taken the money, but they've not yet done the work. Then, when the work is actually done, when the ice cream is given to the child, the company will debit or reduce the unearned revenue and recognize the revenue. That's the reason you can tell your roommate that even though they got the cash in, let's say, December, they won't get to recognize the revenue until the work is done, which might be April or May of the next year. Because it's the earning process that creates the revenue, not the collection of cash. This is Joe Hoyle speaking to you from the University of Richmond. We're talking today about liabilities, and our first example is a liability created by something that's relatively new, a gift card. Have a great day.